Good morning, everyone. Welcome to this weekly update. And given the action of the last week in America, I reckon it's safe to say that the character of markets is definitely starting to change. Now, that's pretty much what we'd expect at this time of year, so comes as no surprise. What is unknown at this stage is whether this is just going to be another short-term spike to the downside, perhaps a 3 to 5% mild pullback in stocks, or whether this will actually develop into something a little bit bigger and we get a more traditional 10 to 15% correction. I'm starting to lean towards the latter, I must say, but the strength in the American market has been such that one can't really be that confident about a decent correction in America. The rally has just got enormous power behind it. So we won't know the answer to that question for a couple of weeks, but certainly the warning signs are there. And in this particular update, I want to go through the actions that I believe traders should take at this time of year. So as I said, the character of the US market is definitely changing. I think there's no question about that, and I'll show you several indice charts in America that make that pretty obvious. It's looking like traders, the big traders and the hedge funds are taking profit off the table. The stocks that had led the market higher over the last 6 to 12 months, particularly the NASDAQ and also technology stocks in general, and biotechnology stocks, healthcare stocks. They're the ones that have been leading the market up, and they're the ones that have come off quite sharply in the last 1 to 2 weeks. So definitely profit taking happening there, and we'll have a look at the NASDAQ 100. Want to have a look at the Russell 2000, which is the broader index of the market, covering stocks from 1,000 down to 3,000 market size. We'll also take a look at government bonds because they moved a little bit higher, and still a possible breakout into phase 2, but hasn't happened yet. So I've been talking about that over the last couple of weeks. Another aspect too, which is a little bit representative of markets reaching a peak, is that junk bonds have moved higher as well, which means yields have fallen. And so overall credit quality is declining. And again, that's something that tends to happen towards tops in the market. But that is certainly a bigger picture one, and we may not necessarily see a significant change there for 6 to 12 months. The other aspect that I also note is that there's been more low quality IPOs that are coming to market. In other words, more of the junky type stocks are being floated, and people are prepared to put money into really poor quality IPOs, but equally they're failing. We're not getting the big profits on day one, and in some cases we're even getting a price decline on day one as well. So definitely the quality of what's happening in the US market is declining. So let's have a look at some charts. We'll start with the S&P index. And you can see it was a fairly sharp move down on Friday night, which came pretty much from nowhere. Now, the S&P index, the jobs data was quite solid, and the S&P index almost touched 1900. And when I first looked at the S&P index, my first thought was, look, this is just a technical reaction off a major level, off the 1900 level, and it pulled back, and that may prove to be the case. However, when we look at some of the other indices, you certainly see a pattern emerging that indicates there might be a bit more substance to it. But if we pan back and look at the S&P, you can see that the 150-day moving average has been a support level for that, and it's just continued to rally higher. So we'll wait and see. The S&P could pull back to around 1800, and that would still be quite normal within the context of the overall rally that we've seen. It finished the week at 1860 or 1865, so we would actually need another 2 or 3 Friday nights to, for things to have changed in the American market. Let's have a look now at the NASDAQ index. This is the NASDAQ 100. Now you can see if we go right back to the left-hand side of the screen, it's just been a series of higher highs, brief pullbacks of no more than a few days to a week, and then it moved higher. And that was the case up until recently. Now, this time, however, we've got a break of this peak in January and also these lows of March. So that was the first break. We've now just had a second break. So we've now closed below a second low point. So this is a pattern that we've not seen for quite some time in the NASDAQ. Now, it's still above its 150-day moving average. So there's no need to kind of panic at this stage. As you can see, it's been way above that moving average for quite some time. So it's still in positive rallying territory. There's no question about that. But the fact that we're now getting lower highs and lower lows indicates that the character of the market is just changing. Now let's have a look at the Russell 2000, and we're seeing a similar kind of pattern, not quite as pronounced as we saw with the NASDAQ, but you can see we have broken these lows. We broke the first set of lows, and we're yet to break the second set of lows. But again, as with the NASDAQ, the 150-day moving average is still intact, and the price is still above that index. So this is all fairly preliminary at this stage, but as I said, my whole thesis is that the character of the market is changing. We're not getting the same level of support from the market that we've seen for quite some time. Now let's have a look at bonds, and this is the 20-year government bond index. And if money, you can see we've had a decent fall in bonds, and we've formed this big phase one base that's been in progress now since about the middle of last year. We haven't broken out of the phase one base, but you can see it's towards the top. We did get a partial breakout, and then it came back into the range again. But if this breaks and closes above 110, 111, then that's indicating that money is flowing into the bond market. And if money is flowing into the bond market, that means it's coming out of equities, and stocks will fall. So that's one to closely watch as well. Just while I'm here, let's have a look at the Australian index. Now this will obviously reverse on Monday. We ended up making gains on the week in the Australian index, but I would imagine that will probably come off somewhere between 50 and 100 points on Monday, and then we'll see where it goes from there. So we gained 56 points on the week. It will pull back on Monday. How our market responds to US weakness, I really don't have a strong opinion on, because our banks have done extremely well, and miners have also outperformed the banks in the last week or two. So it's a little harder to anticipate how our index might perform. But frankly, I don't pay too much attention to our index. As you know, I focus more on stock-specific situations in Australia. Our index is just representative of a small handful of stocks, and I think is, to a degree, is a bit meaningless. Moving on now to precious metals. Gold gained $4 on the week, and commodities were generally pretty flat. So gold had a good session on Friday night when stocks pulled back sharply, and it's trying to bounce from the 50% retracement level, as you'll see, but overall it's still within a phase one base. So it's possible that gold could still pull back further, and that gold stocks could also pull back further within that overall phase one base. But I've certainly seen enough in the last couple of months to give me optimism that it won't be too far before we see a breakout in gold and gold stocks. Silver, of course, has failed back into the range and is underperforming gold, and is disappointing, and I don't quite understand why that would be. That's a little bit different. Copper was steady at $3.01. And was steady on Friday night, which is interesting when stocks were were falling fairly sharply, and also crude oil remained steady at 101. So let's have a look at those charts. First of all, let's just take a look at the gold chart. I'll take a bigger picture view of gold. So this is towards the left-hand side of the screen here is October 2008. So this was the gold price after the sell-off after the GFC. Price then moved from roughly 700 to 1900, and it's basically pulled back to the third Fibonacci level. Not quite, that was at 1154. It pulled back to 1181, which is pretty close in the overall context. And we've formed a double bottom in the gold price. And you can see that this whole area here is forming up as a phase one base. Now you'll notice that the other thing that's changed, of course, is that we've now got the purple moving average, which is the 50-day, has now cut the red 150-day for the first time in a long time. So that's really the first sign that the character of the gold market has changed. You can see the red 150-day moving average had flattened out. The 50s turned up and crossed it. We got a break of a previous high here. So the character of the gold market has still changed. But to break out of this overall phase one base, so this is, let me just mark up this phase one base here. So that's what I'm calling the phase one base. To break out of that, you can see we need to move above this peak in August of 2013, which was at around about 1440. So we need to break above that level to indicate a breakout of phase one. I'll just get rid of that just to make a little easier, a little clearer to see things. So therefore it's possible that gold could return and do a retest just below 1200. I wouldn't rule that possibility out. But equally, it could just continue to consolidate in this phase one base for months to come. But ultimately, we're looking for a break above 1440. Now, if we turn to the GDX, you can see it's a very similar sort of pattern on the GDX, which is what you'd expect. Again, you can see that the shorter term moving average, the 50-day, has crossed over. The 150-day has basically leveled out, and the price of the GDX index has started to spend a lot more time above that moving average. So definitely the character of the GDX gold stock market has changed as well. So nothing definitive yet in terms of a new phase two bull market. It needs to close above $31 for that to be the case, but we certainly are seeing a change in character. And I think if we look on a bigger picture view, what we're seeing is stocks starting to form a top, and gold stocks starting to form a bottom. So this is the spot copper chart. You can see we had a bit of a dip, got down just above $2.90. It's pulled back above $3 and is just sitting there for the moment. So from an overall strategic approach, there's a high probability that the correction has started. So I think you need to consider cashing up to a degree, because this will be the opportunity to get some better bargains that we've really been starved of for quite some time. My strong advice would be to get rid of all speculative positions and all low quality stocks, because if we do get into a bigger correction of 10 to 15%, those stocks will get hammered pretty much universally. So if you've got speculative stuff or low quality stocks that you've been hoping would rebound, I can tell you that they're probably not going to in the medium term. So I would get out of those and position yourself for the next phase. Gold stocks still building in phase one, and we're now seeing gold stocks starting to take market leadership from some of the previous market leaders. So that completes the summary for this week. For anyone that would like more information about what I do and how I provide additional support to traders, You can find out more information on our website, or you can contact me directly. There's my email address there. So that's it for this week. Interesting times. Cheers.